What if I told you that right now, beneath the surface of every stock price, every mortgage payment, every promise your government makes about economic stability, there's a shadow market worth over $400 trillion. That's not a typo. 400 trillion. That's 5 times the entire global economy, and almost none of it is real. You've been told the 2008 financial crisis was a one-time failure, a learning moment. Regulations were passed. Banks were reformed. The system was fixed. But what if 2008 wasn't a bug? What if it was a dress rehearsal? See, while you have been grinding through inflation that has stolen 20% of your purchasing power since 2020, while your rent has doubled and your wages flatlined, there's been a silent explosion happening in the derivatives market and the shadow banking system. An explosion so massive, so interconnected, that when it detonates, it won't just take down banks. It'll take down currencies, governments, the illusion of wealth itself. Here is the big reveal. The global financial system has been permanently transformed into a collateralized hostage crisis, where synthetic derivatives and shadow banking have created a doomsday machine that's too big to fail, too complex to regulate, and too profitable to stop. And the people running it know exactly what they're doing. Before we go further, drop a comment below and tell me where you're watching from. I want to know this message is reaching people everywhere, because what I'm about to show you isn't theory. It's documented, it's happening, and it's accelerating. If you're tired of sanitized financial news that protects the elite, hit that subscribe button. This channel is about unfiltered truth. Now, let me show you how we got here. Let's rewind to 1994. Most people don't know this year. It's not dramatic like 1929 or 2008. But 1994 is when the fuse was lit. That year, Orange County, California, declared bankruptcy. It was the largest municipal bankruptcy in American history at the time. The county treasurer, a man named Robert Citron, had been gambling with public money using something most people had never heard of: derivatives, specifically inverse floaters and structured notes. He leveraged the county's $1.7 billion portfolio into a $7.5 billion bet that interest rates would stay low. When the Federal Reserve raised rates 6 times in 1 year, the entire position imploded. Orange County lost over $1.6 billion overnight. Sound familiar? Because while Citron was being prosecuted, while schools and public services were being slashed to pay for his gambling losses, Wall Street was watching. And instead of seeing a warning, they saw an opportunity. They saw a product that could generate obscene fees, bypass traditional regulations, and operate in the shadows where no one could see the risk building. By the late 90s, derivatives had gone from a niche product to the fastest growing market in history. And here's the key. These weren't just financial instruments. They were weapons of mass abstraction. You could take a mortgage, slice it into 1,000 pieces, repackage it, slap a AAA rating on it, and sell it to pension funds as a safe investment. The original risk never disappeared. It just got hidden, layered, obscured behind so much complexity that even the people selling them didn't understand what they contained. Sound familiar? By 2007, the notional value of the global derivatives market had exploded to $681 trillion. That's 45 times the size of the entire United States economy. And the majority of this market was over the counter, meaning it was unregulated, unreported, and invisible to the public. It was a shadow banking system operating parallel to the real one, except it was bigger, faster, and built entirely on leverage and mathematical models that assumed housing prices would never fall. We all know what happened next. 2008, Lehman Brothers collapsed. Bear Stearns vanished. AIG, the insurance giant, was hours away from detonation because it had sold hundreds of billions of dollars in credit default swaps, essentially insurance policies on toxic mortgage securities, without having the money to pay out when those securities failed. The entire global financial system froze, not because banks ran out of money, but because nobody knew who was holding the bad debt. The derivatives had spread the risk so widely that every institution became a potential bomb. And here's the part they do ain't tell you. The bailout was ain't just about saving banks. It was about saving the derivatives market. The Federal Reserve, the Treasury, the Bank of England, the European Central Bank, they all coordinated a multi-trillion-dollar rescue operation to keep the shadow banking system alive. They didn't dismantle it. They didn't regulate it into submission. They fed it. Sound familiar? Because today, in 2025, the global derivatives market isn't smaller. It's bigger, way bigger. Estimates put the notional value at over $1 quadrillion. 1,000 trillion. And it's not just mortgages anymore. It's everything. Corporate debt, sovereign debt, commodities, currencies, weather. Literally, there are derivatives based on rainfall and temperature. The entire economy has been securitized, packaged, and turned into a casino where the house always wins and the public always loses. But the real evolution isn't the size. It's the structure. After 2008, banks were told they couldn't take on as much risk. So they didn't. They moved it. They shifted trillions of dollars in derivatives and risky assets into the shadow banking system. Hedge funds, private equity firms, money market funds, special purpose vehicles, entities that look like banks, act like banks, lend like banks, but aren't technically banks, which means they don't have to follow banking regulations. They don't have reserve requirements. They don't have transparency. They operate in the dark. And they're all interconnected through derivatives contracts that tie them to the regulated banks, creating a web so tangled that no regulator, no government, no central bank can map the full risk. So how did this happen? How did the global financial system become a collateralized hostage crisis? The answer is a mechanism so elegant, so brilliantly corrupt, that it's still legal. It's called rehypothecation. And if you've never heard that word, you're not alone. It's intentionally obscure, but here is what it means in plain English. It is the practice of using the same collateral multiple times to back multiple loans. Let me break that down. Imagine you give your car to a bank as collateral for a loan. That's normal. But then that bank takes your car and uses it as collateral to borrow money from another bank. And that bank does the same thing. And again, and again. Your one car is now backing 5, 10, 20 different loans. If any one of those loans defaults, the whole chain collapses because there's only one car. Everyone thought they had collateral, but it was an illusion. That's rehypothecation. And in the shadow banking system, it's everywhere. Investment banks and hedge funds take client assets, securities, bonds, stocks, and use them as collateral to borrow more money, which they use to buy more assets, which they then rehypothecate again. It creates a leverage spiral. And the numbers are staggering. Before 2008, some banks were rehypothecating assets at ratios of 50 to 1. For every $1 of real collateral, they were creating $50 of loans. After 2008, the United States and the UK limited rehypothecation, but only partially, and only for certain institutions. Hedge funds, private equity, the shadow banks, they're still doing it. And it's worse now because the leverage is hidden behind derivatives contracts. The same treasury bond can be used as collateral in a repo agreement, then as margin for a derivatives trade, then as backing for a collateralized loan obligation, all at the same time. It's the same asset, layered into multiple financial products, each one assuming it has exclusive claim. And here's the truly insane part. There's one person who saw this coming, who warned the world, who tried to regulate derivatives in the late 90s and was destroyed for it. You won't believe the name. Or maybe you will, because the story of how the shadow banking system became untouchable isn't just about greed. It's about power. And the receipt is wilder than you think. Her name was Brooksley Born. In 1996, she was appointed chair of the Commodity Futures Trading Commission, the CFTC, the agency responsible for regulating derivatives. And almost immediately, she saw the problem. The derivatives market was exploding. It was unregulated, opaque, and dangerous. She proposed a simple concept: transparency. She wanted derivatives trades to be reported. She wanted to know who was taking on risk and how much. Wall Street went ballistic. And I mean that literally. The response wasn't just opposition, it was warfare. Alan Greenspan, the chair of the Federal Reserve, personally intervened. So did Robert Rubin, the Treasury Secretary and former Goldman Sachs co-chairman. So did Larry Summers, Rubin's deputy and future Treasury Secretary. All three of them, in coordination, told Bourne to back off. They argued that regulating derivatives would stifle innovation, harm liquidity, and damage American competitiveness. In 1998, they went further. They pushed through legislation to explicitly prohibit the CFTC from regulating the over-the-counter derivatives market. Bourne was forced out, and in 2000, Congress passed the Commodity Futures Modernization Act, which made it illegal to regulate most derivatives. The shadow banking system had won. It was now untouchable by law. 10 years later, the financial system collapsed, and Brooksley Bourne's warning was vindicated. But here's the thing, nothing changed. After 2008, Congress passed the Dodd-Frank Act, which was supposed to regulate derivatives. But the law was so watered down, so full of loopholes, that it barely made a dent. Most derivatives are still traded over the counter, still unregulated, still invisible, and the market has exploded. Let me give you the numbers, because this is where it gets truly obscene. In 2008, the notional value of outstanding derivatives was $681 trillion. By 2013, it had peaked at $710 trillion. Today, in 2025, the Bank for International Settlements, the central bank of central banks, estimates the notional value at over $1 quadrillion. Some independent analysts put it higher. Now, I know what you're thinking. Notional value isn't the same as real exposure. That's technically true. Notional value is the face value of the contracts, not the actual money at risk. But here's the problem: gross market value, which is a measure of actual exposure, is still over $20 trillion. That's larger than the GDP of the United States. And when you factor in leverage, when you account for rehypothecation, when you remember that the same collateral is backing multiple contracts, the real risk is unknowable. It's a black box. Let me give you a concrete example. In 2023, Credit Suisse collapsed, not because it ran out of money, but because of a crisis of confidence. Investors started pulling their funds, and the bank couldn't meet its obligations. Why? Because its balance sheet was so stuffed with derivatives, with leverage positions, with rehypothecated assets, that nobody could figure out what it was actually worth. The Swiss government had to force a merger with UBS to prevent a contagion. And here's the kicker: Credit Suisse had over $30 trillion in notional derivatives exposure. $30 trillion from a bank that was supposedly worth $50 billion. But Credit Suisse wasn't unique. Every major global bank has derivatives exposure that dwarfs its actual capital. JP Morgan Chase, $54 trillion in derivatives. Bank of America, $37 trillion. Citigroup, $48 trillion. These numbers are publicly reported. They're in the bank's own financial statements, but they're buried on page 273 of the annual report, in a footnote in language designed to obscure. And it's not just banks. The shadow banking system has grown even faster. In the United States alone, shadow banking assets are estimated at over $30 trillion. Globally, over $200 trillion. These are institutions that lend money, take on risk, and create leverage, but they don't have deposit insurance. They don't have access to the Federal Reserve's discount window. If they fail, there's no bailout mechanism. Except there is, because they're all interconnected to the regulated banks through derivatives. Here's how it works in practice. Let's say a hedge fund borrows money from JP Morgan to buy corporate bonds. That loan is secured by the bonds themselves. But the hedge fund doesn't just sit on the bonds. It uses them as collateral to borrow more money from another bank. And it takes that money and buys more bonds, which it then rehypothecates again. The hedge fund might have $1 billion in actual capital, but through leverage and rehypothecation, it's created $10 billion in positions. Now, what happens if those corporate bonds drop in value? The hedge fund gets a margin call. It has to put up more collateral or sell assets. But if everyone is doing this at the same time, if there's a market shock, the selling becomes a cascade. Bond prices collapse. The hedge fund can't meet its margin calls. It defaults. And suddenly, JP Morgan is holding collateral that's worth a fraction of what it lent. But JP Morgan also has its own derivatives positions tied to those bonds. And so does every other bank. The default spreads. The contagion begins. This isn't a hypothetical. It's exactly what happened in 2008 with mortgage-backed securities. And it is what almost happened in 2020 when the repo market seized up and the Federal Reserve had to inject $4 trillion into the system to keep it from collapsing. And it's what happened in 2023 with the regional bank failures and Credit Suisse. But here's the most terrifying part. It's faster now. In 1929, the crash took weeks. In 2008, it took days. In 2023, it took hours. Why? Because everything is algorithmic. High-frequency trading, automated margin calls, AI-driven risk models that all use the same assumptions and all fire sell orders at the same time. The speed of collapse has accelerated to the point where human intervention is almost impossible. And the central banks know this. The Federal Reserve, the European Central Bank, the Bank of Japan, they've all wargamed these scenarios. They know the derivatives market is a doomsday machine, but they're trapped. Because unwinding it would require a controlled demolition of the entire financial system. It would require admitting that the majority of global wealth is synthetic, that the asset prices, the stock market, the bond market, the real estate market, they're all inflated by leverage and derivatives. And if you pull the plug, everything collapses. So instead, they keep printing money. They keep bailing out the system. They keep pretending that regulation works, but it doesn't. Because the shadow banking system is designed to evade regulation. It's designed to be opaque, and it's designed to be too big to fail. Let me give you one more number to drive this home. In 2024, the Financial Stability Board, an international body that monitors global financial risk, published a report. It found that over 75% of derivatives transactions are concentrated among just 14 global banks. 14. That means the entire derivatives market, the entire shadow banking system, is controlled by a financial oligopoly. And these banks are all interconnected. If one fails, they all fail. This is the collateralized hostage crisis. The global economy is being held hostage by a system that's too complex to understand, too large to control, and too profitable to dismantle. And every time there's a crisis, every time the system wobbles, the people in charge don't fix it. They double down. They add more leverage, more derivatives, more opacity. Because the alternative is admitting the truth, that the emperor has no clothes, that the $400 trillion isn't real, and that when the bubble bursts, there's no amount of money printing that can save it. So where does that leave us? We're living in the largest financial bubble in human history. Not just stocks, not just real estate. The entire structure of global finance is a bubble, built on leverage, built on derivatives, built on the illusion that synthetic wealth is the same as real wealth. And the stakes are higher now than they've ever been. In 1929, the crash was contained to the United States and parts of Europe. In 2008, it was global. But governments could still coordinate a response. In the next crash, and make no mistake, there will be a next crash. The speed will be measured in hours. The interconnection will be total. And the tools central banks used last time, zero interest rates, quantitative easing, bailouts, they're already exhausted. Interest rates have been at zero for over a decade. Central bank balance sheets are already bloated with trillions in assets. There's no more ammunition, and the shadow banking system is bigger, more leveraged, and more opaque than ever. Here's the philosophical lesson. Every empire, every system, every bubble tells itself the same lie. That this time is different. That we've learned from the past. That the experts have it under control. But denial isn't wisdom, and complexity isn't safety. It's camouflage. The people running the system, the bankers, the regulators, the central bankers, they know exactly what they've built. They know it's unsustainable. They know it's going to collapse. But they're trapped in a game where the only move is to keep playing. Because stopping means admitting the truth. and the truth is too catastrophic to acknowledge. So they keep the music playing, they keep inflating the bubble, they keep telling you the economy is strong, employment is low, markets are at all-time highs. And meanwhile, you're paying 20% more for groceries, your rent has doubled, your wages haven't moved, and you're being told to be grateful. The system isn't broken, it's working exactly as designed, to transfer wealth upward, to privatize gains and socialize losses, to create an illusion of prosperity while the foundation rots. So what do? You educate yourself. You understand the mechanisms. You stop trusting institutions that have proven, again and again, that they serve themselves, not you. And you prepare, because when the bubble bursts, and it will, the people who understand what's happening will be the ones who survive. If this video opened your eyes, if it made you angry, if it made you want to dig deeper, then share it. Send it to someone who still thinks the system is fine, and hit that subscribe button, because this channel is dedicated to pulling back the curtain on the lies we are fed every single day. Here's my final question for you. Are we wiser now? Or are we just walking the same path in better suits? Drop your answer in the comments. I'll be reading every single one.